It's my pleasure to now welcome back our keynote, Ron Weissman from Band of Angels in San Francisco. Ron will be discussing the key components of a successfully executed capital strategy, and I also welcome back Marcel van den Assum to join Ron in the second part of his session.
It's a pleasure to be here. One of the things I most enjoy doing is angel outreach. I have been recently in Chile, in Buenos Aires. I've been in Melbourne. I have worked with groups in Paris. I've met with some folks in Brazil and Slovakia recently. You are second to none. This is a crowd that is sophisticated, it's experienced. The issues you're dealing with are way ahead of most angel communities I'm aware of, including in places like St. Louis and Chicago in the US. You could fit into any of my favorite communities. I want to congratulate you on the fabulous job you've done. My good friend Ian Sobieski, the head of the band, who suggested I attend, I was telling him, look, Ian, I've been commuting to Melbourne on some business, and he says, forget Melbourne, you are going to adore New Zealand, and boy, is he right. So it's a thrill to be here. The U.S. is awash with capital, and we all know too much capital can be its own problem. You have done an amazing job with far less capital, which means you have to be at the top of your game, which many of us, fat, happy, and a bit flabby, don't have to be. So, congratulations. As you can tell, I speak with a foreign accent. I don't speak proper English. I'm an American. So, to aid comprehension, I am going to be using slides today. And finally, my last prefatory comment is I am not flying over here from San Francisco to tell you the way things should be. I'm here to keep you from making the mistakes we have already made so that you can make your own unique mistakes. I do have a challenge today. It is 5:15, and my subject is capital models. So meet a new angel investor, meet Julia. Like many new angels minted from Facebook or from Twitter or from Salesforce IPOs, Julia is entranced with the story, and she wants to tell you about the long-term vision. She loves the product demo. She can't wait to talk about just how cool this product is. Julia is going to lose her capital because in Julia's world, capital models, which I think are one of the biggest risk factors we all face, are exquisitely boring. And my task in the next half hour or so is to tell you why this is something that you as angels ought to really care about. Most of my colleagues in the US are new to this kind of a topic, and I'm doing just as much evangelization there as anywhere else. So we're going to talk about why you should care about capital models, what they are, how this fits into how we think about risk. Let's look at some new sources of capital. Issues and best practices in raising this kind of capital, look at what capital does to outcomes, and then summarize some lessons from angels. I'm going to speak very quickly. These slides will be made available to anybody who would like them. So what's a capital model? Every sector, whether it's enterprise software, whether it's biotech, whether it's consumer internet, has its own capital model. And what's a capital model? Really simply, how much money will the company need to achieve significant milestones, like to get to the next round, to get to break even, to exit? And when you put all this together, you have a capital model. It has timing, and it has likely sources of capital. Now, if you're investing in a seed stage and you can't figure out where Series A is going to come from, assuming you need that, you might want to rethink that seed stage investment. So at every stage, you need to be thinking about the next stage. On the opposite side of the balance sheet for the capital model is what's the return profile? What's the typical multiple of revenues that companies in this space get in the public markets or during M&A? And you need to be able to balance how much is going in with how much is likely to go out. And you need to do this at every stage of investment. And yes, we know that seed and Series A are highly risky. We don't know a lot, but we do know is comparables and peers from other companies in the sector. So that's what a capital model is. when we think about capital, we are not just buying equity in a company. What we're really doing is buying the metrics and the milestones needed to get to the next stage of company development. So the capital model and the company's business plan and metrics and milestones have to tightly integrate. When I talk about milestones, I'm talking about these things. For a seed stage investment, getting them to their MVP, connecting them with angels like us. At the angel stage, proof that this actually works, proof that there's early customer interest, strong technical and business founders on the team, and some smidgen of life from some VCs who might want to follow on, even as we're doing this round. So these are the typical kinds of milestones at every stage. I'm not going to talk about most of them because what we as angels care about is getting from the angel round to Series A and maybe Series B. But if this company becomes scalable, they will have to deal with all of these milestones, which are risk factors for every stage of development. As I mentioned, capital models come in all shapes and sizes based on the sector you're in. So there's the Kickstarter model where for $20,000, $30,000, $40,000, people can pre-buy a product, and that creates both some money and it creates evidence of market demand. I don't know an investor in the States who does not require a Kickstarter project for any physical, tangible consumer product. Then there is software as a service. How many of you are SaaS investors? All right. How many of you know what the investment bankers say is the capital requirements to get to exit for a successful SaaS company? 20 million? How many people think it's 20 million? 25 million? 40 million? Well, the number at the last conference I attended, looking at all the public SaaS companies, is $100 million. So these are the kinds of factors you need to understand before you invest a dollar of your own money. Obviously, lean internet startups doing consumer internet can get to scale far less until they go into their marketing phase. Medical devices fall somewhere in the middle. Biotech, can be based on the kind of business plan, can be extremely expensive. It used to be called $1 billion bet. So understand the capital model of the sector you're investing in. And there's no generic capital model. It is your model based on the company you're evaluating. There are any number of capital strategies that companies will go through, going from the incubator phase of $50,000 to $120,000 through the angel phase, which is in the range of a couple of $100,000 to $2 million, through Series A, Series B. Series C is often a corporate venture round where the company acquires formal partnerships, potentially leading to exits. Later stage, Series C, Series D, international expansion with a different class of investors at each phase. Along the way, you can bolster that company via joint development agreements, common in the life sciences, increasingly happening as well for enterprise software, where companies pre-buy or invest or pay for the first serious product with non-dilutive revenues. Once you are a Series B company with stable cash flows, you can even qualify for venture debt. Again, non-dilutive, but potentially very damaging if that venture debt is loaded up with covenants. And finally, there are opportunities to create some liquidity via IPO, via M&A, and increasingly via private equity, which is very active from mid-stage on these days. In my last 4 exits, 2 of them have been private equity roll-ups. So let's take a look at risk, which is what we should all be really caring about. The ultimate question, and this is what Alan May said, it's what I said, can we make money on this investment? And then if you go one level deeper to say, what are the risk factors in our being able to make money? So what's the risk from our perspective? Not from the company's perspective, but from our perspective. Well, there's technology risk. Does it work? Can it work? Can it scale in real life? And my investor friend, angel friend, Julia, this is what she cares about. More sophisticated is management risk. As Alan said last night, do we have the right management team for this deal? I interviewed 3 former Cisco developers, fabulous people who built networking products together. Problem was they were pitching me on an internet deal to sell women's handbags. Not even a single one of them was a woman. So you want to make sure that the team is right for the deal. Market risk, will customers buy it? Competitive risk, can this company dominate its markets? Be aware that in terms of exit math these days, the first company to exit big time via M&A or IPO usually gets 40, 50% of all the dollars the sector will ever create. And the second company may get another 25%. So if you're 7th, 8th, or 9th, you're going to be fighting for scraps, 1 or 2 or 3%, if you ever exit. And finally, there is capital risk, which is our subject today. Will the business need so much capital that we as angels almost mathematically certainly will get wiped out along the way the minute there is a hiccup? And just as risky is, are there sources of capital for this company beyond Series C and Series A? So counterintuitively, from an angel's perspective, the more money the company needs to raise, the greater the risk. Now, I normally think that the companies that need to raise lots of money have a different kind of risk profile, but for us, that's very serious risk. So the risks include, can I find follow-on financing? There are some smart CEOs working with a favorite investor put a mutually assured destruction clause in the term sheet called pay to play, which means if you don't follow on with his investment, you get crushed. And I have seen cram downs as great as 10 to 1 or 20 to 1 for investors who didn't follow on, particularly a down round. There's misaligned investor risk. The more people on the board, the more chances there are for conflicts, because somebody who came in at 50 cents a share and somebody who came in at $5 a share have extremely misaligned interests, particularly during M&A time. We all know about liquidation preferences, which should make the subject of a great novel, by the way, that topic. The more capital you raise, the more money is stacked on top of the original investors. Who gets crammed down? We get crammed down. So we have early investor cram down risk. The bar to exit for us is higher. And then we have down round risk as well. The longer the company stays alive, the chances are the economy hiccups or the company hiccups, and the next round is less than this round. So as you go up the funding tree, there are capital risks. And I have seen this all too many times. I was on the board of an incubator who at one point was worth $500 million in assets. They couldn't follow on. They didn't have capital to follow on. All they had was capital to invest in the initial round. And that $500 million quickly became tens of millions of dollars in asset value as they couldn't keep up. So I've seen that, been there personally. So one capital strategy, and it's not what I'd recommend for every deal, but something to think about, and my last couple of exits with the band have been this, is what is a potential VC buyout, where the VCs want to own more of the company than the company is willing to give, or that we have a sweetheart relationship with the VCs, and they will come in and buy our seed stage shares. One deal I received a 2x, and one deal I received a 5x in 7 months after I made the initial investment, working with friendly VCs who were greedy, who needed more equity than the company could sell. So this avoids the later stage risk of cram down. It avoids the later stage capital risks. So part of the magic here is partnering with VCs early on so that they become friend rather than foe. So let's look at where capital is coming from these days. I'm about to give you an eye chart, and I don't expect you to read it. But there are many, many sources of capital going from incubators to angels, to seed funds, to corporate VCs and venture debt providers. Let's just focus on one of those, which is angel finance. We all know that we're motivated to make 10 to 30 times our money. We want personal value creation. We want a mentor. What we fear are down rounds and VC cram down. That's a primary angel fear. Our role investor, mentor, coach, and our security is the ability to price and term this round. And that's why most of us don't like convertible notes. And an uncapped convertible is a complete anathema because the CEO is betting that he's going to use our money to create milestones to get a valuation that we never originally would have agreed to invest in. So if you cap the convertible, you can at least mitigate that kind of CEOs using our money to cram us down. What do we want with our money? We want an anchor investor, an anchor executive, somebody we really believe in. We want 6 to 12 months of runway. What we really want are whatever the milestones needed to be to get to the next round. Crowdfunding is extremely popular here in Europe and in the US. In the US, it's chartered by the Jobs Act. And it's for small retail investors who would otherwise be putting their money into stocks and bonds. There's usually a $1 million funding cap in the US, and there are individual caps, typically around $10,000, somewhat a bit higher, I think increasingly so, but there's some real limits based on your income tier. And the only way the companies can sell is through broker portals, intermediaries, and iBankers. So the good news is this is a really ready access to capital. It democratizes angel investing. It creates hundreds of thousands or millions of potential angels as opposed to a restricted number. And it's fast time to money. But it's got some negatives too. It's costly. Some deals in the US, 20 to 30% of the money raised can go back to brokers and fees. Most VCs I know will not look at a crowd-funded deal because they'll say, why couldn't you get money the real way from real investors? What did you have to do that for? Not all VCs are that way, but most of the VCs that I know have that attitude, so you can take a reputation hit. If you need to raise money within a year, those people who gave you money cannot come back, according to at least US law. The SEC has been sending out warning letters about fraud. When we tried an earlier form of crowdfunding in 1999-2000, that led to a flood of lawsuits about fraud. Finally, my buddy Ian Sobieski, the managing director of the band, and I often talk about what models are right for angels. In our view, there's nothing that takes the place of that personal touch. You getting directly involved with doing diligence with a company you're about to invest in. No nicely bound prospectus, no matter how shiny, is going to take the place of that. And by the way, the shinier the prospectus, the more diluted we all get about how real all those facts are. So crowdfunding is great, but it also has some potential liability. Corporate venture is extremely hot. Right now, there are in the US over 1,100 corporations, many of them from abroad, have corporate venture funds. In the last couple of quarters, typically 20% of all money spent in the US on early stage deals was spent by corporations, and about $2.3 billion was recently deployed. This is less dilutive. These guys care more about access to early technology. They're less financially motivated. They often bring a customer, i.e. a business unit with them. Folks like SK Telecom, with whom I work, South Korea Telecom, use their network of partners in Asia to find customers for their investee small companies. And CVCs operate at every stage, often from seed or Series A on up, a great source of capital. So let's look at some issues and some best practices here. Part of what we need to do as angels and board members is what I call capital planning. And the way capital planning works is you need, first of all, to raise the next round to demonstrate to investors that you have met the metrics and milestones for this round. You need to measure that success. And that means you need to extend the fundraising horizon out by 3, 4, 5 months post the time you think you will achieve those metrics. You are not going to get funded the day you get your 50th customer, and that's what you had promised. You're going to get funded, a month or two later. So you need to look at cash flow and to sustain cash flow, not only through the achievement of metrics and milestones, but through the fundraising period that follows. And certainly you can get lucky. Multiple competing term sheets can shorten this process a lot, but this tends to have this kind of wave cyclical flow across rounds, because at every round you need to prove something, then you need to sell what you've proved. We all think of high valuations as great. We're looking for this round to have a really, really high valuation. And that means we take less dilution, it's evidence of progress, and everybody goes out with a glass of champagne because this is awesome. In my experience, too high a valuation, and right now Silicon Valley is stupidly caught up in all of this, can be a big negative. If it's not based on fundamentals and it's based on hype or competing term sheets, the next round is a huge risk, because the next round can be a down round. If you're ahead of your valuation by a year, and you don't even make the milestones you were supposed to have made to justify this round for the next round, you're going to get a down round. So who gets crushed? Anybody? Who gets crushed in a down round? We do, right? We do. We can always re-up management so they get less crushed, but there's nobody to re-up us. So, down rounds are not our friend. Finally, too high a valuation, if it looks like the company's worth $150 million, you're going to limit the number of companies who can buy that company should they want to be sold in the near term. So this is good news and bad news. Who should do the fundraising? This is a topic of hot politics, and I really hope to offend a few people in the audience here. Because the right people to do fundraising are the CEO and the CFO and the senior management team, assisted by the board. Again, I said these slides are being made available. Existing investors are great, particularly if they agree to come back into the round. What you want to avoid are passive investors who are not going to come back, and most of all, intermediaries who take a success fee. Since they're getting paid to fundraise, why would you believe anything they have to say? They're getting a success fee. They're getting paid to fundraise. And yet, right now, Silicon Valley is filled with deal guys and brokers, all of whom are trying to shop deals around. So I just hang up the phone when they got one of these guys on, even if they're my friends. I say, I don't want to hear it. Are you personally investing? If so, I'll listen. If not, it's not what I want to hear. So it is your job to help fundraise. It is the CEO's job. And if the CEO is too busy and needs to outsource fundraising, you have to ask why. There's one situation where it's fine to outsource fundraising, and that is if you're moving cross-border. And then you do need to have local affiliates and friends help you, link you up with the right person. But if it's not a cross-border deal, you have to ask yourself 3 times, why is the CEO not doing this? VCs versus angels. And I've got to say that I am bimodal today, because I'm both a VC and an angel. Although today I'm speaking to you as an angel. Are we natural adversaries? Are we partners? And the answer is both. So the more capital we raise, the greater the chance of dilution or pay-to-play risk. And by the way, there is no such thing as prior round protection in a term sheet. A term sheet specifies what's going to happen right now. But I have seen on the many boards I've sat many times where the follow-on investor says, you better abrogate those investor rights if you want me to invest. We're not going to give you the early investors that preference or whatever it might be. So a term sheet is an extremely useful organizing piece of fiction. Because there ain't nothing in a term sheet that a follow-on investor can't demand to be changed. So the only protection you have is the goodwill of the management team and the goodwill of the follow-on investor. And that's why you should be dating some follow-on VCs, you should be showing them deals, you should be syndicating, so that they not only don't want to cram you down, but can actually keep you afloat and give you some extra benefits, to give you a little re-up, as has happened to us, if the VCs really, really like you. So build syndication networks. And if you become close to VCs, you might even arrange a partial or total early VC buyout. But most VCs who you do not know love building companies on other people's money. And they love arranging a cram down. They love redoing the cap table. Thank you very much for your capital that got us to this point. We'll steer from this point on. And oh, by the way, you now own half of what you did before. There are some protections we can go into over drinks. But another problem I want to talk about is the growth capital barbell problem. We know where to get $50 to $2 million in places anywhere in the world, from Silicon Valley to China. The problem is, what do you do? We also know, by the way, that international investors, the big investors, the Excels, the NEAs of the world, can write very big checks, as can private equity. The problem is, what do you do between 2 million and 20 million if you don't have a vibrant venture ecosystem? And that forces companies often to have to move offshore. So there's some strategies. My first role as an international VC was moving companies between the US and Europe and vice versa. You keep development back at home. You target multinational VCs who have offices in both regions. You do what you're doing today, which I love, really encouraging syndication amongst angel groups. If a single angel group can't fund the next round, or you syndicate with other angel groups, often foreign angel groups. What was popular a few years ago was buying a US company or a German or a British company, a small company, and using that as the base of your operations and your products when moving abroad. And something I think is extremely important, and not everyone does it, is leveraging the expatriate community in Silicon Valley. The Israelis, the Indians, the French have done a great job. Most other geographies have done a so-so job using their citizens who live in the valley to create ties with later stage investors. One of my favorite companies called Scality, an object storage vendor co-located in Paris and Silicon Valley, has shown President Hollande that for every job in Silicon Valley, they create 2 jobs in Paris, and it's a win-win. So create those win-win strategies. So let's look at capital and outcomes. I'm so quickly coming to a close. So there was a study that's been mentioned earlier of $500 million in angel funding in US and UK deals. And there was some really interesting conclusions. The study was updated in 2013, and it's still relevant. Investors who visit companies once a month have 3 times the outcome, typically, of investors, angel investors who are passive. So please take that to heart. Active investing is good. Angel deals across all sectors that yield $50 million exits are unusual. And we'll talk about the implications of that. So this study looked at deals that returned less than 1 times the money versus deals that returned 10 to 30 times the money, and these were the differences. People who were looking for a quick fix, under 3-year hold, did not do as well as people who held for the long term, unless there was a really nice VC buyout. Deals that angels did outside their domain expertise typically had those under 1x returns. Deals where angels were experts had very high returns. Deals where the total diligence was under 20 hours did not do well. Deals with more than 20 fit the best category. And where there was extensive post-deal monitoring, people serving on boards, people visiting companies, the returns were much, much higher. The average angel return across all these deals was 2.6x, and 75% of all the dollars were returned by 10% of all the deals. I've done studies every quarter of the M&A market in the US for angel and venture-backed companies. For the first quarter of 2015, which was better than Q3, the numbers looked like this. 81% of M&A deals were undisclosed. In real-world language, that means they were too small to show up on the financial statements of the reporting buyers. 3% had under 1x return, 8% 1 to 4x, and 7% 4x plus. What does this mean in English, even American English? 15% of M&A deals in Q1 in the US made money for investors. And we know that 95% of exits tend to be via M&A, and only 4 or 5% tend to be IPOs, except in unusual quarters. So really understand the dynamics of M&A well. What's the implication here for us as angels? Well, the more capital you put in does not yield better returns. That's one of the observations of the study, that more capital is not going to create necessarily a better outcome for angels, because more capital ultimately means eventually more dilution, more cram down, which balances all the good things that capital does at the same time. Between 1996 and 2006, and then reaffirmed again in 2013, only 15% of angel deals yielded more than $50 million in total proceeds. What does this mean for you? What this means for you, again, this is where the capital model comes to play. You should not be investing in deals that are going to require a company be valued, at much more than $20 or $25 million in most cases. Why? If your round is a $25 million post at some point, that means you will make, under this model, a 2x on your money. So be very sensitive to what the returns profile are in your specific market. Now, clearly, there are many cases where these numbers are actually very incorrect. That's in that 15%. But you better be darn sure that you're going to be in that 15% and not in the bulk of angel deals, which yield less than $50 million. So let me sum up with some lessons for all of us, things that I've learned the hard way. First of all, let's talk about two capital models. There is the capital model that the company's CEO is working with, and that's the broad model, how much they're going to need over time. Then there is our angel capital model. What's the model we want in our heads, after which we think this is no longer a game for us, and what might want to provoke an earlier exit. So what's in the interests of the investee company may not be in our interests. There may be a cram down round coming, there may be a recap. It may be raising so much money that the direction changes profoundly and we get left in the dust. So be aware of this and deal with conflicts of interest responsibly. Talk to corporate counsel, understanding your fiduciary role as a board member, if you are one, as opposed to your role as an investor. It's as hard, but you need to be aware of that these conflicts will inevitably happen with later stage companies. Cultivate VC partners to protect your interests, because they want to keep you alive for the next deal. They like your deal flow. They love what you do, early stage mentoring, and they want to be your friend. And remember that in some cases, early exits can reduce the risks of all of these issues we've talked about. So, lessons, last slide. Don't confuse your angel capital model with the investee's capital model. Understand where you fit into their capital raise. Understand the company's capital and returns model based on its sector, based on its peers, based on what you know about the company itself. And do that before investing, so you have some sense as to what the future looks like. Capital efficient deals are your best friend. At the band, we have a special fund for capital efficient deals that will not need more than one round of venture funding because of everything I've mentioned today. Scale your investment to likely outcomes. And we mentioned that $50 million number, and that's US dollars. And yes, you might exceed that, but be aware that that's been the typical outcome. So scale your investment appropriately. The more capital, the greater risk of your and our dilution. To avoid early cram down, it happens to all of us, reserve $3 for every dollar you invest, because your baby companies are probably going to need it, particularly when the economy slows, particularly if venture shuts down for a while, particularly if limited partners are spending less money with their venture firms, that they may need us to fill those gaps. Series B, Series C buyouts can be your friend. Partner with VCs to avoid those kinds of cram downs, and actively monitor milestones and metrics. You will be asked for follow-on investment, and how else will you know whether this is a good idea or not if you are not in control of the metrics of the company. So these are my messages. That's why capital models count, and we're going to dialogue.
What's your recommendation for building a portfolio that tries to manage the expectation of what you're trying to get out over the long term?
You can repeat the question, please.
Yeah, so what's your, so how would you build a portfolio, or what does a portfolio look like to optimise the outcomes along the lines of these, the data that we've got? Is that right, Dave?
Yeah. There are two different strategies. One strategy is called thesis-based investing, and it's something that most of us as angels really don't have the time to do. With early stage VCs do say, hey, big data is going to really be disruptive of the government sector or financial services. I'm going to look at 10 different companies. I'm going to learn the space. I'm going to pick one and invest. Sometimes angels can do that. Most of the time, it's just too time consuming. So we are typically reactive, but you can react if you have a pro forma profile of things you look for. And I build a profile based on things I look for. My number one rule, and it's, again, to quote Alan from yesterday, is I love it when I see a management team that's just as excited about building the business as they are about building the product. If they're metrics driven, if they're doing something unusual, if they're being disruptive, we have a lot to talk about. So I have a few screeners myself, and then I also invest in sectors that I know a lot about. Now, some of my friends invest in the old spray and pray. They do very well, doing many, many deals in areas they don't know about. But I don't know how I follow on with a follow-on round if I don't know what the company's really all about.
The one thing we've been counselled by Bill Payne, Basil Peters and others about is the importance of using third-party M&A advisors. Now, you counselled us the reverse.
Question?
So I won't mention any of the names, but the question was, we've been counselled to use M&A advisors, and Ray pointed out that you advised the opposite.
Okay, I'm speaking of advisors in two different senses. Yeah. I absolutely believe in using intermediaries and iBankers for M&A. I was speaking of early stage fundraising when the CEO is fundraising Series A or Series B. In that case, it's the CEO's job. When it comes to M&A, you absolutely want to use an iBanker because they have a broader network than you do, than the CEO does, and they can create auction environments and competitive pressures. So I'm all for investment bankers at M&A, but that's different from Series A or Series B fundraising. Is that clear?
You talked about understanding the capital model and the returns model for each sector of the company that you're going to invest in, or the sector of the company where it operates. We all know that most of the stuff we hear in those early stage companies is lots of guesswork, lots of bullshit, carry on, right? You were talking about metrics. I don't know how good it is in the US. How do you expect all these other countries where angel investing is just picking up and we're getting to sort of some sort of maturity to have that sort of metrics, to actually make sense of it? So is it a task we end up doing just to make ourselves feel good, or is there real value in it without rigor?
That's a great question. Let me answer it in a couple of ways. First of all, metrics does need to be something big and scary. For me, metrics are things like, you have given me, you're asking me for money. How many, what are you going to do with it? How many customers are you going to attract over the next 6-9 months? How many partners are you going to attract? How big is your sales force going to be? What are you going to be assigning as sales goals? Things could be as simple as that. They don't need to be. We don't need to have econometric models here, but every company that's asking you for money needs to have a plan. That plan needs to be numbers based, and those numbers can be locally based. They shouldn't be based on the U.S. numbers, but locally based on what's reasonable. But if you're not tracking what the company told you it's going to do and asking why the gaps appear, and many times those gaps are reasonable, you're not doing as thorough a job as you could in post-deal monitoring.
I'm just going to ask for one number from you, just a guesstimate. A large percentage of our investments, not just in New Zealand, but in other angel communities, are follow-on. So 80%, 70% to 80% are follow-on. In your experience of follow-on investments, how many are for the right reason and how many are for the wrong reason?
Okay.
What's the weighting of follow-on
I'll give you a
investments?
test. I'll give you a test.
I don't want any tests.
All right.
Give me a number.
I would say that at the time we made the follow-on investments, most are for the right reasons. And if you're investing, I'll further qualify it, if you're investing with a group and most of the members of the group follow on, that's probably the right thing to do based on the information we had at the time. Individuals who are not part of a group doing individual angel deals can be swayed by other factors, personal loyalty, emotion, other kinds of things. But the investment decisions made by the investors in the deal, typically, I've rarely seen one where I said, why are you following on? This is crazy, if they've agreed to do that. So I think most cases, it's the right thing to do.
In the presentation, you made the comment about the companies with good cash flow and only need one raising, where they're promising they only need one round to get to an exit. Do they have a premium valuation in the American market?
So the question was, I think, Jeff, on the companies that fit the capital model of one round to exit, do they attract a premium? So hitting for the fences on one round, so obviously a profile of company there. So what's the sort of the valuation kicker associated with those sorts of ventures?
The investment banking adage is companies are not sold, they're bought. Many of the companies that get acquired after one round of funding do so because they're filling a desperate need from an acquirer. And the acquirer is not looking at financial metrics, they're looking at how much they can be accelerate by, and they might be looking at some competitive pressures. So it's not unusual that if there is an exit after one round, that it's a nice exit, but you can't count on that. As I said, companies are bought, they're not sold.
Yeah, I guess I was really referring to the difference between companies that clearly need another round.
I love your experience, you tell. Because many of you have one and done deals, and what did you see?
Hey, Jeff, we might have to take this after the session because we need to wrap it up. Got a great session. We've got all night to carry on the discussion across the other side of the lake. Ron, hey, thanks so much.
It's a pleasure. All right, thank you.